So I was saying I really want to thank members of GIC for putting this together. This is probably the first event we're doing, and thank you so much to Jatin sir for making this happen. For most of us, we know who Jatin sir is. For some of us who are not that well acquainted, I'll just give a brief introduction and then we'll get started. So Jatin sir is the managing partner and CIO at Stalwart Advisors LLP, SEBI-registered portfolio management services firm. Jatin sir has 14 years of experience in investment analysis and portfolio management. Prior to founding Stalwart Advisors in 2014, Jatin sir was working with a Delhi-based family office as the head of research. He's a CFA charter holder, earned MBA in finance from Christ University, Bangalore, and a graduate in commerce from Delhi University. Jatin sir has a passion for teaching. He's an instructor at the Flame Investment Lab, Pune, and also hosts India Investing Conclave, a pioneer in online investing conference. I highly recommend you check out the website. As a way of giving back to society, he has been an active volunteer with the Art of Living since 2006, where he has led multiple state-level fundraising campaigns. So we all want to welcome now with a round of applause for him, please. I'll just take 2 more minutes on a more boring but very important topic, which is the disclosures and proper disclaimers. The views, opinions, and content shared in the session are for educational and informational purposes only and do not constitute investment advice, financial advice, or recommendations to buy or sell any securities. Nothing discussed here should be construed as a personalized financial advice. Participants are advised to conduct their own research or consult with a qualified financial advisor before making any investment decisions. The speaker and organizers shall not be held liable for any damage or loss arising from reliance on the information provided during the session. I think most of it is obvious, but I'll still go through it. Investing in the stock market involves risk, including the risk of loss. Past performance is not indicative of future results. The session may include references to publicly available information, personal experiences, and opinions which are subjective and may change over time. By attending this session, you acknowledge and agree to the disclaimer. So with that, I'd like to invite Jatin sir on the stage.
Thank you, Rahul, for that warm introduction. Good to see a big enough turnout on a hot Sunday afternoon. I hope it's worth your while. So Rahul met me last year in October at a CFA event, and he said, we have Gurgaon Investor Club, and why don't you come and address us? And since then, we were trying to coordinate. I'm glad, finally, I'm here and getting to meet all of you. So like Rahul, I'm also going to bore you with one important slide before we move to the main presentation. Okay, it's not working. Let's leave it. So, quick disclaimer and disclosure. My firm Stalwart Advisors is registered with SEBI. We have past and present ownership in the stocks we are going to discuss today. It's purely for illustration purposes. And please refer to your financial advisor before acting on it. Okay, so a quick background about myself. I'm meeting a lot of you for the first time. So just before we get to the presentation, a brief about me. I'm born and brought up in Delhi. Fairly modest background, and the reason to mention this specifically is because I think as investors or as fund managers, this kind of determines our relationship with money too, right? And given this background, I am very conservative. I've never done F&O in my life. It's not even activated in my account. For me, capital protection has always come first as an investor or as a fund manager. I funded my higher education through scholarships, and stock market was complete serendipity. So until my MBA, there was no plans to pursue this as a career. But in my second year, I had a visiting faculty who introduced this side of markets to me. Otherwise, being born and brought up in Delhi, markets की reputation अच्छी नहीं है. We all know that, right? I mean, 90s or 2000s में एक term चलती थी, operators चलाते हैं market को, and things like that. You grow up listening to your uncles and aunties talk things like how people lost so much in markets. But I think this was for the first time in my life that somebody was introducing the other side of markets to me. So my professor too was a rags to riches story, and he left a very high-profile CXO job globally to pursue his passion of full-time investing, and seeing his portfolio and those stocks which he bought in 90s and 80s and 2000s, up 100x, 50x, and then being introduced to Peter Lynch, Philip Fisher, Warren Buffett, Charlie Munger. A bulb goes on, right, when you figure something out in life, and that was the moment for me when I think it was amply clear that given a choice, I would want to pursue this as a full-time profession. Then I worked two jobs under awesome mentors in Delhi, and for the first 3 years, I got great exposure. I traveled the length and breadth of country, attended a lot of AGMs, saw a lot of plants, and got a good exposure and confidence to be on my own. 2014 is when I floated this firm called Stalwart Advisors. SEBI at that time had just come out with regulations called IA, Investment Advisor. And I was perhaps the first 50 in the country to get that license. And that was the beginning of the entrepreneurship journey under Stalwart. The first 3 years were like a dream run. I mean, it was like everything was flying, and so was our stocks. A lot of our stocks went up 5 times, 10 times. And the multiplication at portfolio level itself was extraordinary. Then came the reality check. 2018 was more of a time correction where nothing happened. 19 was a bad year, and 20 was an accident. Most of us have been through that accident. And from the top in 18 or 17 to bottom in 20, we were down 40% at portfolio level. And don't ask me at stock level what was the drawdown. We all know that. But at a portfolio level itself, we were down about 40%. And then 2021 onwards, we had the Dream Run 2.0. So overall, in the first decade of Stalwart, we were fortunate enough to compound at 27% CAGR, which was twice that of market. A lot of beginner's luck here as well. So then it was by 23 that the capital adequacy was met to afford a PMS license, and we immediately applied for one. At that time, the thought process was that if I was an investor in a PMS, what all would I look for? And now when the tables are turned and I'm starting a PMS myself, how can I ensure I offer all those things I would have aspired as an investor in the PMS? So we launched PMS with 8 distinct features. First was that we named it Wealth Guardian in order to be true to label, capital safety first. Second, it was 100% customized. So we are unlike most PMSs or mutual funds, index funds, where you get invested on that day's NAV. Here, we have a buy range, a hold range, and a sell range for every stock we track, and the deployment is as per that. I put $1 million in the fund myself, being the largest investor, ensuring skin in the game. It's like if you're running a restaurant, but you're not eating at your own restaurant, it's a problem, right, for your clients. We kept alignment of interest through keeping a performance fee-based model. This is the single scheme we have, so all our best ideas go in it. Simple, transparent structure, uniform across accounts. Have tried to choose the best ecosystem partners. And lastly, reminding ourselves constantly that it's a profession, not a business. And we have to act as a fiduciary or trustee. If roles were to switch, we would do what we will expect. Recently we've crossed 100 crores in AUM. This is the first small milestone for any PMS. And in the first 2 years of PMS, we've been able to luckily compound at 20% plus. So coming to the main part of the presentation, So, couple of years back, Roger Federer retired from the game, right? And in his retirement speech, he shared some mind-boggling statistics. So he shared that he played 1500 plus singles, won 54% points, but 80% of the matches, right? So he won 54% points and his opponent won 46. In a way, it's a slight advantage, right? Just a 4% extra. Uh, but that led to an 80% win for him. I believe investing in life are similar. All we need is a slight edge for an outsized outcome, right? Uh, so for us, investing is also, we draw a lot of parallels between uh, what he said for his sport and for our sport, which is investing. As long as we are losing less, automatically we are gaining more, right? So the focus is a lot on what not to do. What are the landmines? What are the areas where you tend to lose money? And as long as we are avoiding them, automatically our outcomes are far, far superior than people who are not able to avoid those landmines. So we have a long list of things we avoid. For in the interest of time, I'm going to list a few here. The foremost is avoiding overvaluation at the time of entry, right? A constant reminder that a good asset may not be a good investment. And it's easier said than done, because it's very easy to spot a good asset, but it's extremely difficult to reach a conclusion that it's not a good investment. Uh, a great recent case is Asian Paints. Uh, is it a great company? Absolutely. It's one of the best companies in our country. And it was a great company even 5 years ago. But this is the stock price in last 5 years, right? It has not moved. I mean, it moved a little here and there, and it is where it was 5 years ago. So what changed? It was a great asset then, it is a great asset today, but it wasn't a great investment at that time, and to my mind, perhaps it's not a great investment even today. Uh, this company is not alone. I have a long list of outstanding companies which have gone nowhere in last 3, 4, 5 years, and this was one of the biggest bull markets we've had uh, in last couple of decades, right? So look at the names here, right from Nestle's, Unilever's, which are the FMCG behemoths, to Bata, paint company, other paint companies like Nerolac, Berger, even 3M, Whirlpool. As a basket also, this has generated nil to low single digit returns. Uh, Again, they're great companies, but not great investments. Uh, the other thing we avoid is leverage in the balance sheet. So if you see global data, the single biggest factor for companies going bankrupt is leverage, right? If you don't owe any money to bank, they can't force you into bankruptcy. Uh, so leverage is a two-edged sword. In good times, uh, it helps you, but in bad times, it takes you to the ground. So this is something we avoid. Most of our companies are debt-free companies. Outright governance issues. So if there is a decent listing history of a company, you can go back and see in bad times how did the managements behave. Do they treat minority with fairness? Are they transparent? Do they accept when things go wrong? And are there other issues in terms of governance, through related party transactions, through capital allocation? How are they rewarding themselves versus minority? If there are outright issues in the past, we tend to avoid those companies. And we have a long list of no-go areas. No matter how great the businesses are, no matter how cheap the valuation is, anything multiplied by zero is zero, right? ultimately they are on the driving seat. If they don't want you to make money, you will not make money. The caveat here is light gray is acceptable to us. Again, very subjective. I'll share some case studies going forward. We avoid sectors going obsolete. So no cigar butts or that saying that okay, last two puffs left, it's free. Why not enjoy it? We don't go there. Uh, there are businesses where it's very difficult to see 10 years down the line any terminal value, or 15 years down the line. In between, they have cash flows, they'll have their own cycles, but if the end result is zero, and in any DCF analysis or in any valuation, ultimately majority of the value resides with the terminal value. It's not 5-year, 10-year cash flow, but eventually what is the terminal value of the business? And if that is zero, then for us, it becomes a no-go area. Most B2G businesses, these are private businesses, but their sole or major customer is either a state government or central government. While the going is good, these businesses look good, but only when something goes wrong, you realize how fragile the business model was. Just this week, we know what happened to a company called Protein Gov, right? They're the largest processor of PAN. And in PAN 2.0, they've lost the bid. It is almost half of their cash flows. So these are businesses where people miss out on these fragilities when the going is good, but the minute something you lose one contract and all your cash flows go for a toss. Then we avoid overly regulated sectors. How many of us remember there was a D&D flyover in Noida, Noida Toll Bridge? It's a listed company. And early in my career, I used to attend their AGMs and track it. It was a deep value story. Parak Parik Mutual Fund had and in their previous avatar, PMS, had a good stake here. The concession agreement was going to last till 28 or maybe 2030. But in between, there was a hue and cry, and the regulator stepped in and said, okay, no more. You've recovered all your money that was due to you. You're out of here. Look at tea companies, look at sugar companies, look at OMCs. The interference from regulator, not just in how you conduct your business, not just the good quality parameters which are desirable, but even in terms of pricing, even in terms of commercial decision making, it's mind-boggling. And then, after that you realize it's not a free market. Even if the promoter is very competent and you have a right to win in your industry, but because of such rules, you can't do anything. So these are good trades, but are they buy and hold for us? The answer is no. Most PSUs for similar reasons. We don't deal in IPOs. I think we believe it's a seller's market. It comes at the time when they can extract the maximum juice, not leaving much on the table. And also there's no listing history. We typically like to invest in IPOs which have been at least 2 years, opportunities where IPO is now 2 years old and the industry is going through a down cycle. That's the best time to look at these newly listed companies. Lastly, loss-making startups. I think this is good for a VC model where, it's a basket. So you can have a Zomato and maybe a Policy Bazaar, and you also have Paytms and Nykas of the world, and they, the winner takes care of losers. But in a portfolio where you're just picking one or two, you're leaving a lot to luck. Strategy-wise it works, but at a stock level, it's very speculative. And the reason is, these are new business models, right? Today, a lot of PE money is riding here. They're trying to influence consumer behavior. It's really subsidized. But tomorrow, when the focus is on making money and the subsidy goes away, then only we'll know the real consumer behavior and the profitability of the business model. Until then, as I said, it's really speculative, works at a basket level, but for us, where we are fairly concentrated and we are not a VC fund, it becomes challenging to do crystal ball gazing here. So this excludes about almost 50% of the universe for us. What is our average holding period? We don't say we buy for life. I've met enough promoters, uh, the good humble ones too, who say that I don't know, Jatin, what's going to happen in my business next year. Uh, then we don't have that arrogance to say that when a promoter doesn't know what's going to happen in his business next year, we're going to say we're going to hold this for next 10 years, 20 years, 30 years. I think it's foolhardy to do that. At any point in time, a 3 to 5 year view is what we are trying to form. Does not mean that we sell it on fourth or fifth year. It's a rolling view. You keep rolling it forward as you have the visibility of next phase of business. There are few businesses where this is possible, like Nestle has existed for last century and probably is going to be around for many decades and probably centuries to come. But then it gets excluded in the first basket where valuation doesn't make sense. Otherwise, there is unbelievable disruption everywhere. I think the rate of change which was there in 70s, 80s, 90s and what is there today, every 5 year, the craft, the nature of businesses are changing. What used to take maybe 30, 40, 50 years to happen. Uh, in such a scenario, it becomes very challenging to see beyond. What is the market cap range for us? We are market cap agnostic. We are happy looking at companies between even 500 crores, 1000 crores, and going up to mega caps to lakhs of crores. Having said that, the sweet spot for us has been 1000 to 10,000 crores. Uh, these are companies which are not too small, at the same time not too big to have already been discovered and widely institutionally owned. Uh, most of our alpha, most of our big winners have come when we could enter something at 1000, 2000, 3000 crores market cap. Our bias is, again, we're sector agnostic, but our bias is towards sectors which are growing faster than GDP, growth sectors. And within these sectors, looking for companies which are gaining market share and growing even faster than the sector growth rate. So to give you some examples, a lot of BFSI fits here, pharma and chemicals, agro-processing, industrial goods, which is popularly called FMIG, fast-moving industrial goods. In terms of portfolio construction, we constantly remind ourselves that investing is probabilistic. Sitting today, nobody knows which stocks from the portfolio are going to be winners, which will be losers, because if we knew the winners, then we'll just buy them, right? Why do we buy 20, 40, 50 stocks? Then you buy just top 2, top 5. But nobody knows how bets would work. Some will fail invariably. Uh, Hence, we have a balanced portfolio of about 20 stocks. It's neither too diversified nor too concentrated. Uh, and our average weightage is between 4, 5 to 10%. So that was all. I covered what we exclude. What are we looking for? What are the winning traits? At least that works for us. So in simple terms, if I could just put it in 2 words, what is our investment philosophy? What exactly are we trying to find in our portfolio companies? It's mean reversion. Uh, most things in life just go like this, and there's a mean in between, and you are trying to catch the good cycles. Uh, as you know, there has been no shortage ever which wasn't followed by glut, whether it is tomatoes or semiconductors, right? Uh, After every season, when tomatoes go to 100, 200, and we all crib, what happens the next time? There is so much oversupply that the value drops to just few rupees for farmers. And then the cost to take that from farm to mandi is higher than what you will get at mandi. So what do? They actually dump it on the roads. Every cycle this happens invariably. Uh, and as I shared, it's not just tomatoes. Uh, if you if you remember, during COVID, there was a huge shortage of semiconductor chips. If you bought a car at that time, my brother did buy a car at that time, and they gave him only one key. They said बहुत shortage है, 6 महीने बाद आपको दूसरी key मिलेगी. We were facing that kind of shortage. And what happened subsequently? The prices dropped so badly that the same companies which were making billions, they became loss-making because there was so much glut in the system, right? This is so true in our lives. Look around, and also in the world of business, right? So to explain this, I've put a very simple case study. So we all know Colgate, right? I couldn't pick a simpler business to have this conversation. So what does Colgate sell? Daily essentials, from toothpaste to toothbrush. Most of us use their products from decades. Fairly simple business, no dependency on recession or on our appraisals. It's a straightforward, simple, essential business. And go back and see their history on an average. They've been able to grow their top line and bottom line, mostly their bottom line, earnings per share, at 10% CAGR, right? 100% ROCE business. So whatever they've invested, every year they get the same amount back from the business, and they paid out 100% of that as a dividend. They have a 50% market share today. 10 years ago, it was also 50%. 20 years ago, also it was 50%. So they've grown with the market. They've not ceded or gained market share. It is as simple, predictable, steady as possible. This is their quarterly EPS for last 20 years. Right? See, from here, no drops. Very steady, and it'll be very hard to find any other company which is this steady in Indian listed space. Now, if you have to value this company with all these beautiful traits, how would we value it? To cut it short, let's say we value it at 45 times earnings. कि कोलगेट बहुत अच्छा बिजनेस है, बहुत अच्छी ROE बनाता है, फुल पे आउट करता है, 10% पे ग्रो कर रहा है, प्रिडिक्टेबल अर्निंग्स है, ये 45 टाइम्स डिजर्व करता है. सेंसेक्स और निफ्टी विद मच इंफीरियर मेट्रिक्स ट्रेड एट 22 टाइम्स अर्निंग्स टुडे. तो इसके मेट्रिक्स इतने सुपीरियर है कि बेयर मिनिमम डबल तो ये डिजर्व करता ही है. तो ये 45 पी पे ट्रेड करना चाहिए धंधा. ठीक है. सो हर साल एक ईपीएस है, उसको आप 45 से मल्टीप्लाई करो, जितना स्टडी ईपीएस है उतना ही स्टडी इसका वैल्यूएशन होना चाहिए. लेट्स सी हाउ मार्केट हैज वैल्यूड इट. So at bottom it was 20 P. So this is not stock price of Colgate. This is PE ratio of Colgate. So at bottom it was 20. Very recently at peak it was 70. And mostly it is between 35 to 55. Now imagine if every second year you can buy Colgate at 35 P and after 2 years sell it at 55 P. And in between earnings have also gone up. So you can make 60-70% return every year just by buying Colgate and after 2 years selling it and then repeating the same exercise. Is the value of business changing that rapidly? It's the steadiest business out there. But that's the nature of markets. Now, if markets are this volatile in terms of assigning a P to a business like Colgate, imagine how volatile would it be for businesses where sales, margins, profit itself is very volatile. So mean reversion can happen at sales growth level, at much more violently at a profit margin and ROE level, driven by these two at valuation level, and then based on what management is doing with the cash flows. So mean reversion can happen at 4 levels. The first 3 are widely talked about. There are amazing books about them. Capital Returns is a book about them. Some outfits practice it, like if you go back and see Kenneth Andrade sir's interview, he's very vocal and very articulate about how over the cycles, they have played this style. What is less talked about is, and I believe what is more unique to what Stalwart does, is how we are also participating in mean reversion in capital allocation cycle. So for those of us who are not very well versed with what do I mean when I say capital allocation, I have a small slide on it to explain what does it mean. So in layman terms, it just means a business like Colgate, let's say, they're making 700, 800 crores. Let's say they're making 1,000 crores profit a year. What are they doing with that 1,000 crores? Are they reinvesting it in the core business? Are they diversifying into new businesses? Are they acquiring other companies? Or are they simply returning it to shareholders through dividends or buyback? Essentially, these are the four things you can do with the profit you are making. And it might seem कि इसमें क्या बड़ी बात है, कोलगेट तो फिर भी कोलगेट ही है, वो 1,000 करोड़ के साथ क्या कर रहा है should not be too material, but it is. So how many of us know that Wipro was not originally into IT? Wipro stands for Western India Vegetable Products, and it was an oil company. It was a lot later that they ventured into IT, and that one decision made Wipro the largest market cap company in 2000, and Azim Premji the richest Indian. Of course, there was a tech bubble too. Let's keep that aside. But that one decision for the group changed their entire trajectory. For SRF, maybe in last decade, a big capex into specialty chemicals changed the face of the company, right? The opposite of that would be what happened to Kingfisher Group. Beer, whiskey. I mean, इससे अच्छा business हो सकता है कोई? Your customers are addict. Your new competition cannot advertise. Even if government is charging 200% tax, your addicted customers don't mind paying. I mean, if you ask me what is the highest economic mode business in the world, invariably I'll say Kingfisher had those businesses. But they put their capital into airlines, and within 7 years of starting airlines, the entire group hit the ground. One capital misallocation decision. Now you could at that time might be feeling, ये जो भी कर रहे हैं airlines में, I am a shareholder in their liquor business or in their brewery business. It would not impact me. But that's not how the world works. Issues at the promoter level are eventually gonna impact all their businesses, because when they are in a debt trap, it's the crown jewel which will get sold, where the stocks will get pledged, where the pledge will be revoked, and ultimately the bankers are gonna dump those shares in the market, and you will get those MTMs, right? So capital allocation, to my mind, is extremely, extremely important. They can make or break groups. I have some case studies from our own portfolio to illustrate how we've practiced it over the years. And I think more than theory, it's the real life examples that are understandable and easy to relate. So this is a company which was historically a commodity business. They would process oil, which is a low margin business, and low single digit ROC, so no value addition. Was listed forever, and nobody was interested looking at it because there was no history of value creation or doing stuff that adds value. But if somebody went inside the P&L and saw segment data, over the last few years, this was in 2017 looking back, there was a segment called maize processing. What they were doing is they were taking out starch from it, and from that starch making derivatives like glucose, sorbitol, dextrose. These are sweeteners, these are preservatives. So in the cough syrup, the body is actually glucose, or in toothpaste, sorbitol, 70% solution. A lot of sweeteners and preservatives come from starch derivatives. So here the customer was pharma and FMCG, maybe 1% for them in terms of cost, but extremely critical, because one wrong ingredient can spoil the entire product. and hence there was lot of quality focus for the buyers. A new vendor would take 3, 4, 5 years to get approved for these customers. Here they were making steady margins across cycle, very impressive ROC, and decent size. So by 2017 they were already doing 1300 crores in sales and 18% market share. They were already market leader. But for the world, Gujarat-Ambuja was still an oil company. It was not that difficult to find this in segment data, but that was the perception. It had a debt-free balance sheet, and look at the numbers in 2017 when you look behind 10 years. So this 100 crore top line was steadily going to 200, 350, 400, 600, 900, 1000. Look at it. Such a beautiful, steady up move. Look at the margins, very stable. Look at the ROC, again, very stable. So looking back a decade in 2017, it seemed fairly impressive. And they were redeploying all the cash flows in the maize segment. The capacity in maize was going to go up by 2 to 3 times in next 4-5 years. And maize was already 40% of their sales and 65% of profit. And in 5 years, this was going to be all of the business, right? So that was the thesis. Market cap was less than 1500 crores, single digit PE. And mind you, this was 2017, the peak of that small cap cycle. In that cycle, when Tom, Dick, Harry small cap was trading at 20-30 P, this business was trading at a single digit P. And all the traits you look for in a good company, right? In terms of debt-free balance sheet, stable margins, high ROC, so on and so forth. So it worked out well for us. We entered here. At that time, company was making 100-150 crores profit. When we exited, it was close to 500 crores in annual profit. We exited last year in February because there was an adverse action by the management. It's reversed now. Otherwise, we would have loved to even stay much longer. Thesis has only grown stronger, and they are now going into fermentation and continue to grow capacity of their core maize business. It's 5,000 now, it's going to 6,000 tons per day. Yes.
So whether something is a good capital allocation or a capital misallocation can only be known in hindsight, right? For example, you gave the example of Kingfisher. So diversifying into airlines was a misallocation, but Wipro allocating to IT services, diversifying into that area turned out well. So we're calling it a good capital allocation. I mean, is it something that one could know beforehand, or you think we have the advantage of hindsight here?
See, at least in airlines, you can know immediately because
Nobody has made
globally,
money.
what are the odds in airlines, right? In case of a Gujarat-Ambuja or Wipro who moved from oil to a better business, the question is, the new business, is it better than the old business in terms of margins, ROC, right to win?
So you're saying we are almost clear that, okay, airlines are not going to make money, so, I mean, the probability is low.
Odds are against
The odds
you.
are against you.
Yeah, maybe 1 out of 10 airlines would make money, 1 out of 100. Do you want to play those odds? Is your choice. But in Gujarat-Ambuja or maybe Wipro, the odds were far higher in your side because the new business was far better than the existing business. See, they had choice to continue putting money in their existing business, right? No, which were the bad businesses. In case of Wipro or Gujarat-Ambuja, they were in a bad business and they had a choice to continue pumping more money there, which is what most promoters do. It's sunk cost fallacy, right? You can't shut it. You have to continue running it. This is what happened to most people in textile. Every 3 years, new technology. Best to shut it down? No, but you have to keep buying. You're on a treadmill. So it takes a lot of courage and a short-term pain for you to change gears, put money somewhere else. Very few capital allocators or managements have done that.
One more thing, these are past examples. Now let's.
I knew that. We'll come to it. So I have 2 more past examples.
One second.
Yeah.
Now PI Industries we know very well. They have been a very steady compounder, isn't it? And they have been doing very well in agricultural CDMO, if we say.
Correct.
Okay. Now they are trying to get into pharma for the last few years. They have done QIP also. They have raised 2,000 crores or something. Now, but they have not been successful in pharma till now. So, as of today, we will call it as a bad capital allocation. Let's say tomorrow, next year, couple of years hence, fourth, if they are successful, we will call it a good capital allocation. So, how to decide?
See, it's a different case. PI is already in a good business. What they're trying to do is actually increase their TAM, addressable opportunity.
Yeah.
It may or may not work, but you can't take it away from them that they're not already in a good business.
Yes.
So it's a different case. It's black and white in cases where you're moving from a bad business to a good business.
They are into a good business. They are
Correct.
trying to get into a better business, if I can say that.
Not necessarily, it may be as good or even slightly inferior also, doesn't matter. I think attempt there is to increase their addressable opportunity, because agrochemical is only so much they can do. With similar skill set, with similar chemistry capability, can you target pharma? And go back and see a lot of companies globally have done well in both, because there are a lot of synergies. Even pharma companies are doing agrochemical. A lot of them are doing it, right? So it's very hard to say and pinpoint they're doing something wrong. They know their business, right? And their history says that they've done very well.
But last couple of years, few years rather, 3-4
It takes
years,
time. I think these decisions they are thinking decades and you are thinking years. That's the problem.
Yeah, could be.
So they've done a transaction which wasn't minority friendly. They'd given some stake in a material subsidiary to themselves without explanation, without voting, bypassing the minority. They've reversed it now. Yeah.
Sorry, we're just going to pass around the mic if you're asking a question.
Okay, so coming to the second case study I have again from a live one from our portfolio. Live in the sense an actual case where we invested is from 2019, a company called Suven Pharma. Today everybody is talking about CDMO, it's the talk of the town. We understand the business, it's one of the biggest economic moat businesses in the sense that you are with innovator companies from day one, from research to development to manufacturing. And evident in their numbers also, how many businesses in India make 70% gross margin? I can count on my fingertips. 45% operating margins, 30% net profit margins. So the value addition is mind-blowing here. They make 50% ROC, even better than Divi's Laboratories. At that time, they had an 800 crore annual turnover. And yet this company was available at 3,500 crores market cap, which was 16 PE for that year. Why was it so cheap despite being one of the best businesses out there? Because they had a segment of NCE, New Chemical Entity Research, where they were losing about 100 crores a year. It was pet project of the founder, Mr. Justy, where he was trying to find cure for Alzheimer's, Parkinson's within CNS segment. This is the most difficult research area globally. 99.99% of the research here does not yield anything. So from last 20 years, they were trying this and they kept losing money. And obviously, as a listed company, when you have a good business in a business which is losing money, market values you accordingly. What they did, they demerged life sciences business in 2019. That's when we entered, and nothing much changed in the other good business. If you go back and see numbers wise, there was nothing much that changed, and the stock was up 9 times in subsequent 3 years. I think the biggest driver here was, of course, then Cohance came and it got sold to private equity. Those things happened. But even before that, a good 4, 5, 6x move came purely from discovery of the core business once the loss-making business got demerged. We exited in this bracket because valuation stopped making sense to us. A more recent case study, quickly, I'll just spend 5 minutes here, is a company called Usha Martin. The elevator on which we came down runs on their cable. Bridges are suspended on their cables. In mining, in cranes, all the steel wires are mostly made by them. So these are applications which are very critical, and the opportunity cost here is very high. Imagine in a oil and gas operation, if it breaks and you have a couple of hours of loss of production, you're talking about millions of dollars of loss. 80% of their sales are consumables, which means through wear and tear, the same customer, every 3 months, 6 months, 1 year, keep coming back to you. Elevator would obviously, a bridge would have a much longer replacement cycle, but 80% of their sales have shorter replacement cycles of few months to 1 year, where they keep coming back to you and you are an approved vendor. Again, for the client, the cost of these wires is 1, 2, 3% in the overall operation. Hence, not much incentive for them to keep changing vendors for small cost saving. It takes 3, 4, 5 years for a new vendor to get approved. These are all the traits of a good, predictable business. Look at the value addition. They were making 33,000 rupees EBITDA per ton. And look at something like an APL Apollo, which says I'm all value addition, and they make 4,000-5,000 rupees EBITDA per ton. So in steel converter industry, I would say they are one of the biggest value added converters. Some of their products like elevator ropes cost 2 to 4 lakh rupees a ton. And they obviously sell by meter. It's a classic shortcut. If you want to see what companies are commodities and what are selling value added products, see if they are buying by weight but selling by unit. For example, Nestle would buy wheat in tons, but you don't buy Maggi by seeing the weight, right? You buy a packet, and they can keep reducing the weight, but you'll still buy the packet. Similarly, these guys, for a lot of their products, sell by meter, which is a good indicator that yes, they're adding a lot of value, and the markup, the gross margin is impressive. Decently high ROCs across cycle, market leader, 50% domestic market share, 6% global market share. And if you see certain categories like port wires, they are almost a monopoly. 80-90% market share is with Usha in those cables. And for some reason, it was available at a throwaway valuation till 2021. Now, what was the reason? The reason was a decade earlier, they got over ambitious and they said, we buy steel from the market and make wires. Why don't we make our own steel? So they borrowed 4,000 crores, tried to put a 1 million ton backward integrated with own power, with own mines, a steel mill. And then 2017, 2018, down cycle of steel almost brought them to bankruptcy. But what was the solution? The solution was, you were doing a good business of steel wires, you tried to add something, it didn't work, get rid of this, become debt free again, and then focus on the core business. That's what they did. They sold the steel mill at cost to Tata Steel for about 4,200 crores. They repaid all the debt they had, became debt free, and the core business got again discovered and re-rated. We entered here. At this time, the steel wire segment was making 150 crores of profit. Obviously, steel mill was losing money. Today, they are making about 400-450 crores annual profit. It's a good 3x jump in profitability, but a bigger jump has come also because of re-rating, right? They've massively invested in the capex, all from internal accruals. They continue to be debt free, and there is a promise of continuous, for a few years at least, visibility is there for compounding, and valuation at 20x seems to be in the fair zone. So at least for now, we've held on to the full position we have built over the last 4 years. So if you see, what are the common patterns here? The common pattern is the core segments were good businesses. Let's not say they were great businesses. Maybe Suven was a great business. Usha and Gujarat-Ambuja were good businesses. Why were they undervalued? Either because of loss-making segment in case of Suven, because of leverage in Usha and legacy perception in Gujarat-Ambuja. And how did they solve for those problems? In their own unique ways. In case of Gujarat-Ambuja, it was the relative size. Maize became too large. In case of Suven, it was a demerger. In case of Usha, it was sale of the steel mill. And once these things happened, the core business got discovered and re-rated. The underlying pattern here is fixing of capital misallocation. The attempt here is to try to see patterns that have worked for us and are repeatable. And by repeatable, I mean they're more of skill and less of luck. Like playing chess versus playing Ludo. So the idea is to identify patterns and see are they repeatable for us. And these were niche companies where it played out. But if you zoom out and see, it has happened even in conglomerates. M&M, Tata in 2005, 6, 7, 8. They did a lot of capital misallocation. They went out on a buying spree globally, bought assets which they could not manage. And in the last 5-10 years, both the groups have repeatedly said, we are going to dispose of assets where we are not making good ROE. At a group level, you want to make 18% ROE. And they've actually done that. In case of Tata, they did a lot of reorganization. Tata Consumer got merged with Tata Coffee. All the consumer business came here. They got a new CEO. M&M has got rid of bunch of offshore assets, global assets, tried to focus on what is working for them in auto business. And look at their stock prices. And opposite of that is happening in a lot of conglomerates, like Aditya Birla, getting into wires, getting into paints, getting into jewelry. Adani, anyways, has been doing that from last 5 years. They are expanding themselves too thin. The ambition is to dislodge the leader, but it's very difficult to dislodge an Asian Paints in paints, a pipe, Astral in pipes, or a Kajaria in tiles. And if you're not number one, number two, you don't make money. You can get share of sales, but it's very difficult to get share of profits. If you see profit pool globally, it's the leader that has 70-80% of the profit pool. Eventually, my sense is a lot of these segments will get merged or they'll move out. A lot of consolidation will happen, and that would be the time when, like M&M, Tata, in last 3 years, these businesses would also throw up opportunities in this theme, in this framework, when they start fixing their capital allocation. So a recent idea where we have invested in the PMS last year is a company called JM Financial. And the idea to put this is not to share why we've invested in JM, but just to conclude presentation with a live case so that you don't feel we just retrofitted in our old ideas. And the idea is to showcase how we are doing it on a live basis. It's absolutely not a recommendation. We could lose a lot of money in JM. So please take that with a pinch of salt. My only idea is to share on a real-time basis with all of you, how are you thinking about this position? So for anybody related to financial markets, it's a household name. It's our Nestle and Colgate, right? Because they've been one of the oldest and largest investment banks. Nimish Kampani and now his son Vishal Kampani, they've been like the guys behind Ambani settlement of family, Tata IPOs. I mean, that's where they've come from and continue to be there today. They're leaders in most things they do. 50% market share in the segment, in the bracket they deal with. Last year made 700 crores profit with 40% ROE. And yet when we bought it last year, May, it was at 9,500 crores market cap, which was equal to their book value. So what went wrong? Why would a service business, which should ideally trade on a PE multiple, a leader with that kind of matrix, trade at book value? So there's an interesting history of this company. Go back and see, it has never created value. And in fact, it moves when the markets are about to turn. So a lot of people use them as a signal that bull market is getting over. JM has moved now, and now we'll enter a bear market. And they've lived up to that. Even just 6 months back, the stock finally moved and we entered a pain period again. So they've lived up to that expectation very well. Now the question is, jokes apart, why is it what it is? I mean, there must be a story behind it, right? After all, these are the people who help everyone come up with an IPO, get the best valuation out there. I mean, आप दुनिया को पाठ पढ़ा रहे हो, आपको आता है सब, it's आपके बाएं हाथ का खेल है, right? From Ambani's to Tata's, people come to you for that advice, and you are masters of what you do. But for your own stock, something has been terribly wrong in not one market cycle, in not two market cycles, in not three market cycles. It's always been like that. What is the problem? And so many people who came after you, like the whole Inam group, IFL, Angel, Parag Parekh, mutual fund, all of them came around the same time or afterwards, and we know where they are. And for whatever unfortunate reasons, this group, in terms of market cap and wealth creation for themselves and for their shareholders, has been left behind. So, what went wrong? By now, you would have guessed, right? All the three case studies, there was some problem, and the focus was, is this problem getting solved? So, first, let's see what's the problem here, and then we'll come to the solution part. So, they had a large segment in wholesale lending. They were lending to builders for buying land, for land use change, for construction. And as an NBFC, what is your right to win when you don't have CASA like a bank? You don't have a yield advantage. I mean, cost of funds advantage. So it became very difficult to compete in this segment, though they created good loan book. The underwriting was good, no problem there, no big problem of NPAs. All of that was fine, it's just that right to win was missing. The other big business they created was ARC. What ARC means is Asset Reconstruction Company. These are companies which specialize in buying NPA, the bad debt from a bank, where bank does not want to do messy work of recovery. They say, ठीक है, इसने मेरे से 100 रुपए लिए थे, आप मेरे से 10-20 रुपए में लोन खरीद लो, and you deal with them. If you're able to recover more, it's your profit. Otherwise, it's your loss, but I am out of it. And they bought all these assets. They bought Unitech from HDFC in 2015. It's stuck. No money has come yet. They bought Nitco. They bought Bombay Rayon from SBI in 2018. The good part is that these businesses which they have bought, the loans, they are backed by very strong assets. Like Unitech has a lot of land, and land has appreciated in the last 10-15 years. But the problem is with the recovery, with NCLT delays. If you're doubling your money instead of 3 years in 7 years, your IRRs have gone for a toss. You assumed I can make 20-25%, but it took forever, and your IRRs come down to single digit. So some of these, like Nitco has been the mostly out. It got converted to equity. Recently they sold equity to, I think, Autumn Investments. But a lot of them, large ones, are still stuck. To cut it short and explain in terms of, to give you a perspective, 70% of their capital, of their balance sheet was blocked in two businesses, these two. And they did not make any money. So all the heavy lifting was done by the remaining 30% capital deployed in core investment banking. And hence it was trading at book value or below book value. Last year in May, on a con call, promoters said, enough, we've realized it's not working for whatever reason. We're gonna slowly phase out these businesses and release about 3,000-4,000 crores and make our balance sheet asset light. We'll focus on the core services businesses, not businesses where our own money is being deployed and not making any money in return for us. So if this happens, and it's already happening in last 1 year, they've taken a lot of good steps. What we believed could take 2-3 years, they've done a lot of it already. So they are at a good pace. Now the question is, with this capital misallocation getting fixed, can the mispricing go away? Last year, this segment alone made 700 crores profit for them. I believe capital markets is going to have a golden decade. We have some $400 billion that got funded to startups. A lot of them will be successful. IPOs will come. Some of them, even if they're not successful, anyways, IPOs are coming. So a lot of conglomerates are going to demerge their segments and get them listed. A lot of M&As will happen. Corporate advisory is doing well. Although it'll be lumpy, like last 6 months, IPOs got deferred. There is a very strong linkage to market sentiment. It is a highly cyclical business. So JM's trajectory is tied to it. It will also be very lumpy. My sense is, given broking, advisory, and whole host of other segments, at least rough profitability, even in bad years, should be 350 crores. That's our sense. And if we actually think 5-7 years out, the next market, next good bull market, whenever it comes, probably this segment can do about 1200, 1300 crores of net profit. With mispricing going away, if it trades at 15 times, is there money to be made? Maybe yes. What are the other triggers and optionalities here which actually excite us more? Because there are a lot of optionalities here. Things for which we are not paying today, but if they go right, they make a decent delta, decent contribution to move the needle. So they seeded a segment organically. This is not a business they bought, called Affordable Housing Finance. They seeded this in 2017. In about 8 years, they are close to 2,800 crores in AUM. Decent business, most secured form of lending. They are trying to double this book and get it listed in a few years. I think this can add some value. In wealth, they already have about 1 lakh crore of assets. They are in top 10 even when they had no focus. They're focusing here now, want to be in top 3. A lot of recurring revenue here. It's a good business. It works on float. Finally, they were amongst the first private AMCs in India to get a license. One of the first in 90s. And 2008 crash was very bad for them. And it was defunct until just a couple of years ago. They revived it. And now the AUM is 17,000 crores, mutual fund plus PMS put together. They want to be 25,000 crores. That's when they break even. It can happen in a couple of years if markets are okay. I think there are other triggers also, smaller ones, but mostly these 3 are pure optionalities for which we aren't paying today. So to summarize, this is when the announcement came last year in May, June. Stock was 80 bucks. That's when we entered. Today the stock is 120. As I showed the chart in between, it went to 160. Along with markets, it came down rapidly and now it's at 120. My sense is that the intrinsic value today, or in a year or two once this transition is done, could be about 200 odd. And this is purely by fixing capital misallocation, right? So it's like you were doing 2 things. One was adding value, one wasn't. You just stop doing what's not adding value and the other part gets discovered and valued correctly. So this is not very difficult. This is a path on which they are already at. And this is our sense of risk reward here. If how we are expecting capital markets to be over next 5 years, 4 years, the intrinsic value itself can double, right, at about 15-20% CAGR, given the pipeline of activity there is in the market. But this realization of intrinsic value would have to ensure that same capital allocation mistakes are not repeated. So the first part is still visible and easy. It's the second part that would need a lot of monitoring. What they do with treasury, how they manage surplus cash. There's a lot of leakage when you pay out as dividend or even buyback now. So most likely it's gonna stay in the balance sheet now. What they do with it will impact whether the intrinsic value further doubles or not. Today the book value is 101 per share. 101 रुपए का book value है आज. It is an asymmetrical bet in the sense that worst case, if nothing happens, we're looking at going back to book value. So we're looking at a 15-20% downside, right? That's the worst case we are looking at. But if things indeed go in the direction management wants to take it now, we're looking at an upside of maybe 150, 200, 250%. So our downside to upside ratio is 1:10. These are outstanding opportunities in the sense where when you're right, you make outsized gains, but when you're wrong, your downside is protected. And if you see the other three examples also I shared were similar in the way because we were not paying a high multiple for them. The valuation had so much margin of safety that even if we were wrong on those names, we would not have lost much. But luckily we were right and there was a huge upside that we could capture. So to summarize, this is our investment framework. We ultimately think there are only three things to look for in an opportunity: business, management, and valuation. Business is the horse on which you are betting. Management is the jockey, which is making sure he lives up to the full potential. And odds are, how much do you make when you're right? How much do you lose when you're wrong? So these are great businesses. They are run by great managements. But if you pay 130 for 100, you're not going to make money. It's in fact a short way to lose money or not make money for 5-10 years. United Spirits was a great business and it was favorably valued, but it was not run by a management which understood capital allocation. So even this was a no-go for us. JM or Usha or Gujarat-Ambuja are not great business. They are good businesses and they are not run by maybe great managements, but they are decent and they are available at favorable valuation. So you will find that most of our bets would fit in the third bucket where we are playing mean reversion with a lot of valuation comfort, playing great, if not great, good businesses run by decent management teams. So markets are very competitive now. There's a lot of money chasing ideas. I think creating alpha going forward will be very, very difficult. One would have to look in ponds where there is not a lot of competition, and one would have to have horizons which are not 1 quarter, 1 year, 2 year, but 3 to 5 years or longer. We find that comfort in the third bucket. And we've been doing this for last 10 years. Most of our ideas actually have come from this bucket. I want to leave you with this slide. We often assume large caps are safe because they're less volatile. But these are all the large cap companies which were actually part of Nifty and they completely vanished. Some of them are barely on ventilator, but mostly they don't exist anymore. And they were all index companies, top 50 companies in India. So yes, large caps are less volatile, but doesn't mean they are safe. I think safety comes from, resilience comes from business model. Do you have pricing power? Do you have market leadership? Is your balance sheet strong enough? And your comfort with management, right? Those are the sources of resilience and ability to ride for long term. It can be in a small cap, mid cap, large cap. Those are just labels for funds. But for us, I think we should not go by these labels. We should have trades in mind we are comfortable with, we are looking forward to, and then whichever size they are available, they can be our potential universe. So that was my last slide. I'm happy to take any questions. Yes, sir.
About the management, about the practices in the business. So do you consider the management is still a robust management under your framework?
Two parts to management, right? One is governance, integrity-wise. I think no problems there, no issues there. In terms of capital allocation, yes, they took some decisions and it did not work for them. You can deduct marks for them, but they are in the correction phase now. Were the businesses bad by default? The answer is no. But did they have a right to win? Probably it was missing and they took a while to realize it. In ARC, regulatory delays are a lot beyond their control. In lending, when you are not a bank, anyways, your right to win is low because you don't have cost of funds advantage.
Hi, this is Pramod, Jatin.
Yes, Pramod.
So, if you recall, a year back there was some like tax evasion case for Polycab. Right? It was not very significant, but still there was some news.
I think it was significant, yeah.
Okay. So I was holding Polycab from 2021, like 800, 900. At that time it was around 5,000. But due to that panic, I had to sell it at around 37, 3,800. And later I realized that I could have held on to it. So how to avoid these kind of panics when we hear some
Panics
news?
are good. Panics
No,
save you from accidents.
No, but in
There'll
this
be
case,
more such cases where you'll realize you did the right thing. Stocks went to zero.
yeah. But
So
is there any way like
this fight or
can I, yeah,
flight response is good. It's natural to us. There is no way for us to figure out whether the case is genuine or not. It'll take a long time, or it may not ever come out. Uh, do you want to be in doubt holding a large position where such a thing is going on?
yeah,
I would not be comfortable. You have to take a decision for yourself.
yeah? That actually happened with me, and that is why I decided
See,
to.
then the stock did well eventually, and you're learning a lesson that you did wrong thing. You are focusing on outcome to change your process, when in reality the process maybe was okay.
Okay. So I
Because
just
now think if there was actually a problem and the stock was not giving you any exit, because if something bigger happens, then lower circuit to lower circuit, no exit, then would you not have been like, I did the right thing?
yeah, I would
That
have
was
been
also a
happy then.
possibility.
Yeah.
Still be happy with the process and not the outcome is what I'm saying.
Okay.
Our
Got it.
focus should be on doing the right thing versus one-off where we missed it. It'll save you from a lot of accidents.
Got it. Yeah. Thanks.
Yes, sir.
My name is Ambrish. I'm just rephrasing the question which Pramod asked. It's like you stated the philosophy that going forward it's going to be competitive and we should look at a horizon of 3-5 years, right? And this is more at a conceptual level. My question, like in JM Financial, you very rightly, I mean, based on your analysis, said that the downside would be 15-20%. But let's say for whatever reason, it could be an accident like Polycab or anything happening over there. If the value, let's say, goes down below 20%, as a fund manager and investor, would you exit at that level? Or you will wait given your conviction and saying that everything is going right in this management? So even if the drawdown is 40% or 50%, we believe that it'll bounce back.
So we are investing purely based on fundamentals. There are no technicals or stop losses in the picture. If the entry reason is fundamental, exit reason cannot be technical. We have to keep our eyes on fundamentals. If the stock is going down just because of some random market selling and fundamentally the story is intact, there is nothing wrong with either management behavior, actions, or with the business per se, then we'll not exit. We have had cases where we bought something at 100, 150, 200. It went down 50, 60, 70%, especially in COVID. And we ended up adding a lot more than what we bought originally. And eventually worked out very well for us because we kept our eye on fundamentals and not on the stock price. These are diametrically opposite schools of thought. And it's generally not a good idea to mix the two, in our experience.
Thank you.
Hi, Parul over here. See, when it comes to management, it's a very subjective call at times, especially when they are trying to correct some mistakes. When most of the businesses are family owned and you can't judge the competence of the next generation which is trying to correct those, are there any indicators which you look at? Like any proxy indicators in the financials or anything which is coming out, which gives you a sense that, okay, they may be correcting and they seem to be on the right path. Because the management is really, in that sense, untested.
That's a good question. For second generation, it takes a while and there is no shortcut. By the time numbers will reflect it, good or bad, it'll be late anyways, right? Just to give you this example, the last company we discussed, the two segments which they are exiting, the second generation was very closely involved in starting those segments. And now they themselves backing out means a lot, says a lot, because it's like, it's your own baby, right? You started it and now you're accepting that it's not working, let's kill it. It says a lot. It needs a lot of courage to accept that and act on it. Very, very few promoters would do that. So in my book, it's a plus for the second generation. But in most cases, it's very subjective. It takes a long time for numbers to reflect. And it's dicey. I mean, there is no right or wrong, or there's no shortcut to judge it quickly. Yeah.
So I have a couple of questions. First is, what is your sell principle? It seems like it's different for different cases, but in general, when you enter a stock, looking at the fundamentals, how often do you have to change your, as you said, you revise it, there's a periodic review. How often does it change your sell principle based on different situations in the market? And my second question is, your how do you assess a management? You talked about the second generation into it, and that is reflected by after the numbers are come out. But before you invest in a company, prior to the results, there's a change in management. What are certain things you look at to assess management of a company?
Okay. Both are very heavy questions. See, in terms of exit triggers, there can be multiple reasons. The best is that you thought something had happened and you move out. So it's like you thought of an investment thesis. In next 5 years, this can happen. It happened. You made good money and you exit. That's the best case. What else can happen? You thought something. It did not happen. You exit, right? Like sometimes everything is fine, but the stock is not moving for 3, 4, 5 years. So we have a concept called time stop loss, wherein maybe we are ahead, maybe there is something which market sees we don't. If nothing happens for 3, 4, 5 years, while fundamentally everything is good, but it's not moving, there's a big opportunity cost to hold it, right? You move out. What else can be the reason? You find something better. That's also a good reason to exit. Ultimately, you can have playing 11, right? And if you find a better player, you have to make room in the team for him. How do you do it? You keep ranking your portfolio. Let's say we have 20 stocks. We keep ranking it from highest conviction to lowest. And the lowest will be kicked out when we find a better player in the team. The other reason could be that valuation has stopped making sense. You thought of something, the thesis is yet to play out, but market has got so excited about it that it's already pricing in next 5, 10 years of good growth, good margins. This one is very tricky because you can't predict madness of the crowd. In this case, whenever we've exited, stock has still double tripled from where we exited, and eventually it came back and went much lower because the cycle reversed. But our exit was premature. We are still okay with this process because we can't catch the top and exit on the way down. You take stairs on the way up, but elevator on the way down. It's very difficult, especially as an institution, to move out when stocks ferociously circuit to circuit come down. Especially we are in some of the less traded stocks where liquidity is very important. So जैसे चढ़ते सूरज को सलाम होता है, it's easier to liquidate a position when the going is good, the trend is there and people are excited to buy a stock. So we are happy exiting on the way up rather than on the way down. Broadly, these are the reasons. I was anticipating this, so I had prepared a slide on exiting. I'll just see if I have covered everything. So these are the reasons. You can quickly read it. With examples I've put. These are all the companies where we were invested. In terms of management, you have read, can I move on? Yeah. In terms of management, see, this is what we are looking for. Our preference is for owner-operators. So 70-75% of our portfolio is run by promoters themselves. We think when the family is running it, they're really thinking long-term. It's their entire wealth also at stake. Unlike a professional who's thinking just next year bonus or his job security, a promoter, while running the business, can really take long-term decisions. And if it's best if it's a first-generation entrepreneur. We get excited when the age bracket is 40 to 55. I think before 40, you're still learning and experimenting with things. And after 55, energy is too low. So 40 to 55 is the golden period where you've learned a lot of things and have the energy to really put them to practice. We look for skin in the game, no pledging, capital allocation I've already talked about, stability of leadership team, ideally the only business venture of the promoter family, no related party transactions in same line of business. And we like to see a female from the promoter family in the board. it's generally, if there is anything wrong with the business at all, a promoter would not want to have his daughter or wife in the board, because then the criminal proceedings also happen on the female members of the family. So it's generally a very good sign to see that they have, it's run in a clean way. It's not always true, but mostly, at least for Indian families, the data shows it's a good indicator.
Jatin,
Sorry, yes.
this is Vineet. This is regarding the last example which you showed. I understand the management is trying to weed out the marbles and trying to keep the diamonds with them. But those diamonds are also very market linked. For example, the investment banking piece and the AMC piece. And we are already at a peak of the market right now, and we have seen a lot of growth in the market since past 4-5 years.
Yes.
And do you think it is right time to have it in a peak cycle with a market dependent business primarily catering to that?
See, in last 5 years, I've heard markets peak every year, and market troughs also every year. That has been our markets, right? It's been so volatile. It's for anybody to say. I don't have a view on, are we at a market peak? When would be next market peak?
The previous
we look at
examples
only two things.
Yeah.
One is, what is it in the price? Is the price reflecting the peak today? Is it peak margin, peak multiple? Are they trading at 30-40p on peak margins? The answer is no. They're trading at book value. So worst is already in the price, number one. Number two, even if things go wrong, I put in my slide, worst case, it seems 300-350 crore profit, trough pe bhi, bad cycle mein bhi aa jayega. Look at their last quarter. It was the worst quarter in capital markets in last 8 quarters. Their numbers were okay because markets mein IPO nahi aaya to advisory se paisa aa gaya. There are some counter-cyclical elements in the business. Broking is also one of them, right? Still, 300-350 crore trough is what we are working with. What is the third safety lever we have? We are thinking 4-5 years. We are not thinking 4-5 quarters. If you're thinking 4-5 quarters, yes, this is a problem. What if we are in a peak for next 2 years? Absolutely, always. And even if it's like much higher and the thesis is playing out, either ways we are ready to average up or average down. So what are the safety levers we have? Valuation, time horizon, patience to hold, and readiness to average up or average down if opportunity comes. Average up if thesis is picking up faster, average down if stock goes to 60-70. Yeah, we don't go beyond 10. I mean, we are very happy with a 10% allocation at top. Yes, please.
Yeah, my name is Anupam. You spoke about Gujarat-Ambuja. There was a clear related party, clear misstep. And like you said, Diamond has been reversed now. So what is your framework to evaluate or to think about this situation in general and in particular about this case?
We exited the next morning.
No, I'm talking about the reversal, yeah.
No, about the reversal? See, there are two schools of thought here. One is like, if you pick something which doesn't belong to you and you put it back, are you guilty or not? You could still be guilty. And at least in the eyes of law, you will be. But markets are very forgiving. And you have to decide and see whether it was an admission or realization that, okay, it was a misstep, let's fix it, and you want to give them a second chance, or not, is absolutely fine. There are 5,000 stocks to choose from. If you're uncomfortable with this, just give it a pass. There's so many opportunities to be picked up. You need 10, 20 for your portfolio, one in a year incrementally, if at all. Again, very subjective, person to person.
Has there been any liquidity, is there any liquidity characteristic that you monitor? The reason I'm asking is to understand if there's been an illiquid bet that you've made in the past and it has sort of become a problem.
So I think, see, we are not that big a fund that we have to worry about liquidity today. So even in our small cap positions, it has been fairly manageable.
So how, yeah, one question. So how, like with many businesses moving into that leasing assets, how shall we treat that, with companies which have a lot of lease on their balance sheet? I mean, like Indian AS also, like it treats leases as debt now. So like
You should
how
ignore
we
it.
should we price that?
It's a
Or,
useless principle.
okay, I mean, you take it as a debt only and,
No, it's not debt.
okay.
It's
So,
actually misleading, and every time you have to check what is
yes,
real debt and what is
exactly.
discounted lease.
So how shall we look at the lease costs then? Like they are fixed operating costs of the business or?
No, it's a rental.
Yes.
Any rental business would have that, right? It's not debt. It's an accounting treatment which is kind of misleading, and I hope it gets changed.
Yes. And secondly, again, very subjective, like you mentioned about capital allocation. So how shall we see, companies which are like doing capital allocation and then they're the bad businesses, they're just staying through the cycle rather than, not selling. Like for example, SRF in their this textile business or Godrej Agrovet holding on to that Aztec Life Science, Aztec's business. So how shall we see that as a like capital allocation decision? I mean, those are just like great businesses, but or good businesses which are right now through a downturn.
See, it's easier to divert cash flows to a better business and increase their relative size. But it's very difficult to shut down or exit from the bad business. You have commitments to labor, local politics. It's very difficult to shut businesses in India. Also, you have emotional attachment. As long as you're not pumping more money, also is fine. That's how we look at it. You're not burning more money there. You are incrementally channelizing all capital to better businesses.
But
And
sometimes,
if you close, it's even better. But it's rare to see that.
like, but some.
I just have one macro question. Like, a lot of these funds are sitting on a lot of cash these days, and I mean, you look at Parag Parikh and all those, and even the government, when the crash happened from 26,200 and to 21,800, LIC didn't come out to buy anything. Actually, they didn't buy a penny of a stock in this whole crash, and you see that government somehow doesn't want people to go into equity because banks have completely dried up of cash and all the retail money is lying in the SIPs and mutual funds and direct stocks. So you see that as a headwind going forward into the performance of equity markets, because what has happened, I mean, if you look at China market, Chinese don't encourage equity market and most of their capital goes into manufacturing. India today, I mean, Jaishankar today, there was a statement saying that they want the capital to go into manufacturing now. So this is very macro and it doesn't affect us on a day-to-day basis, but eventually if the government doesn't want equity to go up considerably, and we are one of the most expensive markets in the world, and we can stay like this for like next 5-10 years, and a lot of people will just move away from equity, and that's probably the best time, will be the best time to invest. You see government inaction towards equity market can be a possible headwind for the equity performance going forward.
See, funds sitting on cash is a function of their ability to find opportunities. So it's a valuation discomfort, which is the reason why cash is there, right? LIC, I don't know. I have no insight into that. Is government trying to discourage investments?
They're not directly doing it, but if they don't allow the institutions to buy, then probably will not come.
I think LIC does not play that important a role anymore. It was in 90s when they were the largest investors, not anymore. Mutual fund taxation is still the best, right? And mutual fund Sahi Hai campaign is still everywhere. Financialization as a trend, I think, is a mega theme. I am super bullish on it for next 10-20 years. Indian household exposure to financial assets is still mid-single digit. Even if it goes to 10, 15 over next 10-20 years, with the growth in the household income itself and asset base, we're talking about multifold growth. Our AMC industry is still very small. Can be just a short-term problem, 6 months, 12 months, but in the long run, it'll be the earnings growth that will drive, and that has a huge tailwind.
Earnings growth might happen and will continue to happen, but that the same Usha, which is trading as around 22 forward, will become a 6 forward company. Like BMW trades at 6 times forward because it's a growth. Of course, those markets have grown and they don't grow at 5-6%, but there is nothing to say that Usha can continue to perform very well as a business, but can
Absolutely.
become a 5-6 times forward earning company,
So
isn't it?
2013, I bought a lot of companies at 5-10p. That can happen again. Those are market cycles. It will not be permanent is what I'm saying, as long as India continues to grow. Great. Thank you for your patient listening. Thank you.